Are you a bank, NBFC, local money lender or a sahukar? Then this video is for you. So stay tuned till end. The Reserve Bank of India in its press release dated June 8, 2023 issued statement which includes various developmental and regulatory policies and measures related to regulation of default loss guarantee, commonly known as DLG arrangements in digital lending. It has been agreed to establish a regulatory framework for allowing default loss guarantee arrangements in digital lending on the basis of thorough consultations with various stakeholders and in line with RBI's objective of maintaining a balance between innovation and prudent risk management. My name is Monisha, and in this video we will discuss the detailed guidelines on default loss guarantee DLG in digital lending. Looking into its background, the first loss guarantee is a system that pays lenders in the event of borrower's default. Lenders are more willing to make more loans as long as a third party is covering the losses. It serves as loss protection. The RBI stated in its 2022 guidelines on a similar topic that it opposed such arrangements because they would tempt to lenders to take excessive amount of risk. To address this, the Reserve Bank released guidelines on default loss guarantee in digital lending, a step intended to ensure the system for distributing credit in an orderly manner. Coming to the scope, then these guidelines cover all commercial banks, including small finance banks, primary urban cooperative banks, state cooperative banks and central cooperative banks, non-banking financial institutions, including housing finance companies. What is actually a default loss guarantee or a DLG? A written agreement between the regulated entity and a company which agrees to cover the regulated entity's loss from default up to a predetermined percentage of the regulated entity overall loan portfolio. Any other implicit guarantee of a similar character that is based on the success of the regulated entity loan portfolio and is disclosed upfront shall likewise fall within the definition of DLG as per the guideline. Coming to the eligibility criteria for a default loss guarantee provider, so a regulated entity may only enter into a DLG agreement with a specific lending service provider or another regulated entity with whom it has already entered into an outsourcing agreement. The lending service provider offering a default loss guarantee must be incorporated as a company as per the Companies Act 2013. Discussing about the requirements of default loss guarantee arrangements, an explicit legally binding contract between the regulated entity and the DLG provider must support all DLG agreements. The contract must include the extent of the DLG coverage, the format for maintaining DLG coverage with the regulated entity, time frame for the DLG invocation. So coming to the disclosure requirements as per Regulation 11 of the guidelines, a regulated entity may only accept a digital loss guarantee in one or more of the formats as cash is deposited within the regulated entity, as a cash which is held in a scheduled commercial bank, as fixed deposit with a lien designated in the favor of the regulated entity, or a bank guarantee in favor of the regulated entity. Now, as per the RBI's latest guidelines, the regulated entity must ensure that the total DLG cover on each outstanding portfolio indicated upfront does not exceed 5% of the entire amount of that loan portfolio. When implicit guarantees are used, the DLG provider is not allowed to take on performance risk greater than 5% of the underlying loan portfolio. Recognition of non-performing assets is still in place regardless of any DLG coverage offered at the portfolio level, it is the regulated entity's obligation to identify specific loan assets in the portfolio as NPAs and make the necessary provisions in accordance with the current asset classifications and provisioning guidelines. The underlying individual loans cannot be set off with the amount of DLG invoked. According to the terms of the contract, any money recovered by the regulated entity from the loans on which DLG has been used and realized can be shared with the DLG provider. Tenure, invocation and treatment of the DLG for regulatory capital computation, that is computation of exposure and application of credit risk mitigation benefits on specific individual loan assets in the portfolio should continue to be guided by the existing regulations. Invocation, unless the borrower makes good before that time, the regulated entity must activate DLG within a maximum overdue term of 120 days. The DLG's agreement's duration cannot be shorter than the loan in the underlying portfolio with the longest term. Finally, the disclosure requirements includes the regulated entity must set up a system to make sure that the lending service providers with whom they have entered a DLG agreement should post the total number of portfolios and the amount of each portfolio on which DLG has been offered on their websites. That's all for this video. For more similar content, stay tuned. You can also visit our website www.enterslice.com or call on the numbers mentioned on the screen. Thank you.